Good morning, everybody. Hi, I hope you are feeling okay. Are you all feeling okay? Okay, great. I hope the haze hasn't affected you all too much. It has affected me. Morning, I woke up and I started sneezing, and all that. Okay, it's good to hear all of you because just now was quite quiet. I wasn't sure, whether we are doing all right. Okay, but I'm sure after Dr. Pei's session, I'm sure you have a very good understanding of what Singapore Savings Bond is all about, how to go and buy, and all that. Now, my job really is to do this. Every time my job is a simple job. My job is basically to try and share with all of us, after you have a good understanding on the products, how do you actually now use it? Okay, so if you look at whatever that has been discussed by Dr. Pei this morning, it is like you now understand the ingredient. It's like you go to the NTUC FairPrice, you take out an ingredient, you look behind, you now exactly know the nutritional value of this particular product. Now, I'm going to give you like a recipe on how to cook it. So the first part is you have a very good understanding on the ingredients that you're going to buy. My part is how are you going to use it now to go and cook the meal that you want to eat. Get the point? Yes? If you're okay, flash me a smile. Very important, very important to smile. Because when you don't smile, I get very scared. Okay, great. So, let's go in and do that. Okay, so, now, the first thing I'm going to do is I'm going to do a quick comparison between a normal bond, okay, as well as the Singapore Savings Bond. It is very important to understand the differences because once you understand the differences, then we can go and cook already. Then we can go and see how we can use it. Alright, so you look on the diagram on the left. Okay, so if this is a normal bond issued by ABC company. Now, what is a bond? We all understand what is a bond, right? Many of you here, you are my money graduate many times, right? So by now, you all expert already. So you know what is a bond. Okay, so I know it's like quite insulting to you to ask you what is a bond. But let me just say it very quickly. A bond is a debt instrument, right? Yeah, when a company wants to grow or when a company wants to expand its business, they need money. Generally, there are two ways they can raise money. One is that they issue shares. If you buy the shares, you become a shareholder of the company. If the company makes money, they share with you their profits. And that profits is in the form of a dividend. Very good, right? And as the company does better and better and better, the value of the company goes up. If you sell the shares subsequently, you get a capital gain. But there's a second way that the company can raise money, and that is if they borrow. And if they borrow if they borrow money from you, okay, they have to give you an IOU. Okay, and that IOU is like a bond. So let's say ABC company borrows money from you, okay, or a government borrows money from you. So let's say they borrow in US dollar. So you look at a company and you like the company, or you look at a particular government and you like the government, you decide that you want to lend it to them. So let's say you lend US $1 to the company, okay, or US $1 to the government. So you have bought the bond already, okay, and they promise that if you lend them US $1, they promise that they will pay you 5% per year in coupons. That's like your interest. Okay, so far, right? So you get 1 year interest, 2 year interest, okay, so on and so forth until 10 years. So let's say this is a 10-year bond. Yeah, they are borrowing money from you for 10 years. So now, at the end of the 10 year, they will give you back your $1. Simple? Simple or not? Simple, right? That is a bond. So the question is, can you lose money? Yes or no? Can't hear you. Yes or no? Yes, you can lose money. Can lose money, right? Can lose money. How can you lose money? Of course can, but how? Bankrupt, right? Bankrupt. If the company goes bankrupt, then you're not going to get your $1 back. Yes? Yes? Yes. Now, if you lend the money to the government, can the government go bankrupt? Oh, now very loud. Yes, huh? Yeah, because we hear of Europe, all that. We are quite sure now. I mean, last time maybe you think, how can government go bankrupt? Companies can go bankrupt. Governments cannot go bankrupt. But now we know it's possible. That countries, the government can go bankrupt. Can the Singapore government go bankrupt? Technically speaking, yes. Okay, technically speaking, sure can. Well, you're very good. You're now in SG50 mood. No. But possible, right? It's still possible that the Singapore government can go bankrupt. Yeah? But what are the chances? Low or high? Those of you who attended this many times, you know the correct answer. What is the answer? It all depends on how you vote September 11. Okay, no, I'm just kidding. Okay, no, I'm not here to... I'm not a politician. But I said that many times, okay, possible. Okay, but we all know it's very unlikely. Why? Because the Singapore government bond is AAA rated today, which means it's very healthy. But it's still possible. It's still technically possible. So that's one way you can lose money. Now the second way you can lose money if there is a currency, is currency, right? There's a currency risk, right? Yeah? If the exchange rate today, let's say, okay, is $1, let's say, $1 equals to $1.50 Sing, let's say. So, in order to go and buy this bond, you got to take your $1.50 Sing and go to the money changer and change it to $1. Make sense? Then you buy the bond. Yeah, but let's say 10 years later, when you get your $1 back, the exchange rate no longer like that. Let's say now with the $1, you can only change back $1.20 Sing. For example, okay, have you lost money or make money? Have you lost money or make money? Okay, last time you take $1.50, then you change $1 to buy. Now you change back left $1.20, you have lost money. So there is a possibility of currency loss. So it's possible to lose money. Now, the third way you can lose money is if you need to sell it at the wrong time. How? Okay, let's say today this bond is 5% per year coupon. But let's say bank interest now is 7%. I know unlikely. This is just example. Okay, let's say the interest rate is now gone up to 7%. Okay, now let's say you just bought this bond only yesterday. Then today the bank interest go up to 7%. Quite suay lah. Okay, but now you want to sell that bond. You think people will buy from you? No, because why would they give you that $1, right? When they can go and put it in the bank and get 7% interest, right? But let's say you really need to sell because you need money. So what must you do? You must sell it cheaper, right? You can no longer sell it at $1. You bought it at $1, okay, but you can no longer sell it at $1 if you really want to get rid of it, because now it is actually better to put the money for them in the bank. They wouldn't buy from you unless you sell it cheaper. So let's say you decide to sell them cheaper and you sell them at 80 cents. So if you sell them at 80 cents, the buyer buys from you at 80 cents. Straight away he knows that if he keeps it for 10 years, he's going to get $1 back, right? Yes or no? And so he's going to make confirm 20 cents profit. So 20 cents divided by 80 cents is how many percent? 25%. But over a period of 10 years, right, is 25%. So if you do simple mathematics, if you divide by 10 years, on average, you're going to get about 2.5% gain from just buying it cheaper. Am I making sense? Yeah? This is simple, no time value of money and all that simple mathematics. Plus, you're going to get a 5% per year coupon. So, you are going to get, if you buy this bond at 80 cents, you're going to get 7.5%. It is still better than if you buy from, or if you put the money in the bank, right? So, you would then buy. But the person who has sold it, can you see that he has lost money? So, generally speaking, when interest rate goes up, bond price will drop. Am I making sense? Give me a nod. Okay, so that's a bond. Okay, that's a very simplified, simple way, no complexity, no time value of money way of explaining a bond. That's how a bond works. There's another thing about bond. Again, generally speaking, when equities market or stocks and shares go up, bond prices generally goes down. Yeah, and the reverse is true. I always use the word generally because sometimes there is a possibility that the share market drop, the bond market also drop lah. Okay, when people kanchiong, everything drop one. Yeah, because if you don't trust the market anymore, you don't trust the companies anymore, you don't care whether it's shares or bonds, all will drop. Like in 2008, remember 2008 financial crisis? Yeah, there was a short period where everything dropped. It all moved in the same direction. It is possible. Okay, but after a while, you will see it moving in opposite direction. That is the difference between bonds and equities. Okay, Now, how about the Singapore Savings Bond? Now, the Singapore Savings Bond, we know, as it has been explained, so I don't want to take too much time to explain here. Yeah? Basically, it's issued by the Singapore government. It is in Sing dollar. So, you lend $1 to the government. Okay, it is step-up interest. First year, let's say about 0.9. Second year, it goes up to 1.5, let's say, okay? And it keeps on going up until at the 10th year, the interest is at its highest. And we all know already from the first session, if you keep it till 10 years, you add up the coupons all together and you divide by 10, you get the average interest rate equivalent to a 10-year Singapore government bond. Yes? So I don't want to go and explain what happened if you sell earlier. All that has been explained first session already. Okay, so that's the Singapore Savings Bond. Unlike the normal bond, the coupon payment is stepped up, it goes up. The normal bond, usually the coupons is just flat. Okay, they pay you 5%, it's flat throughout. Okay, and at the end of the 10 years, you will get your money back. Can you lose money for the Singapore Savings Bond? Can or cannot? Can, if the government go bankrupt, but unlikely lah. Very, very unlikely. Okay, unless we go bankrupt. Okay, and plus there's no currency risk, right? Because it's in Sing dollar, there's no currency risk. The capital is guaranteed, as we have heard already. So that is the key difference between. Oh, you want to take picture? Is it? Wait, repeat. All right. Okay, can. Okay, so that's the key difference between the Singapore Savings Bond and the other kind of what I call normal bond. Okay, so far. Yeah, once you now know the difference between this bond, let us now see how we can use these bonds and design a portfolio. Because you're going to leave this place, you're not just going to go there and buy your bonds. Yeah, you want to be investing in other things as well. So how do you use the Singapore government bonds or the Singapore savings bonds, as part of your overall portfolio? Okay, and I like to explain it in the context of retirement planning. So, let's say, okay, this is your timeline, okay, and you are now down here regardless of your age. And if you are planning for retirement, okay, I have explained already, if you've come for the previous sessions of my money, at retirement, there are 3 things that you must have. Okay, there are 3 things that you must have when you retire. Can you still remember what the 3 things are? A house, a fully paid house. Very good. What's the second one? You must have that's a house. You must have a good medical expense insurance, yeah? Just in case if in retirement you are ill, you have to be hospitalized, then you have a good medical expense insurance to pay the bills. That's the second thing you must have at retirement. And the third thing that you must have at retirement is that you must have money to be able to pay for your living expenses. These 3 things at retirement you must have. Okay, so from now until your retirement, you will accumulate, and hopefully by retirement you will have gotten these 3 things. And then once you retire, okay, you will now depend on these 3 things to live on until you go upstairs. You understand what it means by go upstairs? Go downstairs better or go upstairs better? Okay, some of you say go upstairs, some of you say go downstairs. I let you decide whether you will go upstairs or go downstairs. Okay, I want to go upstairs. Okay, so I put go upstairs. Okay, so in your earlier years, you will accumulate to the 3 things, but then in your retirement years, the 3 things you draw down, you withdraw until you go upstairs. So there are 2 parts to retirement planning. The first part is the accumulating part. The second part is the withdrawal part. Okay, right? Yeah, so let's talk about the accumulating part. The accumulating part, you are basically accumulating money to buy your house, to pay for your medical expenses, and to make sure that you have an income, okay, that will allow you to draw down subsequently. And then the withdrawal part, okay, is for you to draw down until you finish. So now, in the accumulating part, there are 3 ways generally. Okay, there are more than 3 ways, okay? But this morning, I just want to quickly touch on 3 ways whereby you can accumulate the dollar part. Okay, 3 ways. The first way is you can put your money in the special account. Oftentimes, people miss this. Okay, because if you understand CPF and CPF Life, which I've spoken in a previous session, actually, if you look at the CPF system, what is it? Actually, it is a system that allows you to save money. And then when you retire, Okay, you have that lump sum to buy an annuity, right? Yeah, because in every retiree's portfolio, which I've always said, you must have an annuity. Okay, the dollar part, let me point, okay, the dollar part, a part of it you must buy annuity. Why? Because it is the only instrument that will take care of you if you live too long. Right? Because when you are young, your biggest fear is you live too short. Cannot enjoy life, right? But once you are retired, your biggest fear is if you live too long. Because all your friends go upstairs already. But you are still here. Okay? And then money finish. Right? And if money finish, if you have an annuity, you are safe. Because the annuity will pay forever. It is an instrument that hedges against longevity risk. So in every retiree's portfolio, you must have this annuity. And if you look at the CPF, basically it is just a system that helps you save money, save money, save money, save money. And when you need to buy an annuity, you have been saving for the last 20, 30 years a lump sum to buy that annuity. Yes? Yeah? You can do the same on yourself. On yourself. You can do the same on your own. Okay? How? You can go and buy an insurance plan. Every month you save. Then it matures, right? Then when it matures, you take the lump sum and you go and buy an annuity. You can do it on your own actually. But if you compare to the CPF system gives you a guarantee of 4%. The insurance company won't guarantee you 4%. Alright, so this is one way. If you want to accumulate towards this money to buy an annuity, you can go and top up your special account. It is 4% guaranteed currently. Now the second way is, as I've explained, you can go and buy an insurance endowment plan. It probably gives you about 3% return, not guaranteed. Okay? And then when it matures, you have a sum of money for retirement. You can go and use it to buy annuity also for your retirement. Now there's a third way whereby you can accumulate towards this money. Okay? And the third way is investments. Okay, that's why you are here. You want to learn more about investments. Now, in investing, how much returns depends on three things. It depends on your need to take risks, it depends on your ability to take risks, and it depends on your willingness to take risks. We have gone through this many, many times. So by now, it should be quite clear. But just in case, for those of us who are just attending this first few times, let me explain this. Now, when you are investing towards a lump sum in your retirement, okay, let's say you got another 20 years more to go. For those of us who are younger, we are saving up towards our retirement, and you want to invest towards it. The first thing you got to decide is, what is the return you want? Or what is the return you need? Do you need 8% return? Do you need 5% return? Do you need 7% return to reach your goal? That is the first thing you got to do first before you even start investing. That is the financial planning bit. Okay? You are now down here. From now until you reach your goal, what is the percentage of return you need to reach your goals? It's not difficult to calculate. Okay? If you want to have a calculator to calculate towards that, you can actually go to CPF board website. They have a retirement calculator. You can go and use it, or you can use a CPF retirement estimator to do it. You can go and calculate. But that's the first thing you need to decide. Okay, so far. Yeah? Now, once you determine that return that you need, okay, then you will invest in a portfolio. Investing in different instruments like stocks and shares and bonds to get that return. Okay? But the key is this. In order to get that return, you cannot jump in, jump out, jump in, jump out. I mean, you can jump in, jump out. But only if you're very clever. That means you know when to jump in and then when to jump out. Every time the stock market crashes, you know that it will recover again, then you jump in, right? Then it grows. Then you know tomorrow going to crash now. Then you jump out. Yeah? So That is jump in, jump out. Some people can do it lah. Some people can do it. Very few, but some people can. And even for these some people, they don't get it right 100% of the time. If you belong to that some people that can jump in, jump out, jump in, jump out, jump in, jump out, and get it right most of the time, great, you can do it. I can't do. A lot of people cannot do. Some people can do jump in, jump out, jump in, jump out, jump in, jump out, and they get it right most of the time. But before they get to enjoy their money, they got cancer already. Because they jump in, jump out, jump in, jump out, jump in. It's very stressful, jump in, jump out, jump in, jump out. It's very stressful. Some people can. Okay? But if you are not that type, you cannot. Okay? Cannot jump in, cannot jump out, and then don't want to get stressed, all that. Then the other way is that you must not jump out and jump in at the wrong time. You invest, you stay with it, you ride, you understand? But the head understand, I always say this, right? The head understand, the heart cannot understand, correct or not? The head understand, I cannot jump in, like now market very bad, correct or not? Yeah? Wow, the market, look at the market now, wow, cannot take it. Okay, and you have been attending many My Money seminar, and that stupid Christopher keep telling you, stay invested, stay invested, stay invested. You say, I understand here, but here cannot understand. You understand? I don't know what I'm talking now. But I'm sure you do lah. Most of the time you make decision with the head or the heart. It depends. That's a professional answer. I'll tell you generally, except for you, sir, but generally speaking, most people, they think that they make decision with the head, but most of the time we make decision with our heart, right? Yes or no? Yeah? And unfortunately, if you make decision with your heart without your head, it can be quite serious. I shared this story before, I think, here, but let me just say it again for those people who just came. One of the biggest lessons I learned about the head and the heart cannot connect is some years back, I brought my family for a holiday in Chiang Mai. You heard this story before? No? Okay, some of us say yes. Okay, never mind. So I'll tell you the story. Some years back, I brought my family to Chiang Mai. Okay, on the last day, we went to an adventure park. Very fun. They have paintball, they have go-kart, they have all these things, in the adventure park. And then on the last day, on the last hour, just before we leave the park, my daughter came running to me and said, Papa, I want to go and do bungee jump. So I said, okay, great. Those days, at the time, my daughter was just 9 years old. So I said, go, tell her, you want to do bungee? Go and do. So she went, but very quickly, in the next few minutes, she came back and she said, Pa, cannot do. I said, why cannot? They say, I'm too young. I said, too bad, lor. Next time when you grow up, then you do okay. He said, no, Papa, they said, if you do with me, can. So my wife came, because my wife is a devil, so she came and said, go and do with your daughter. Because if you do with your daughter, you'll be the first guy to jump with your daughter. Don't let the boyfriend has this opportunity. I look at my wife, then you go lah. Why you push it to me? She said, no, but you are the man. I said, okay. So I said, okay, let me go and analyze first. I'm the financial guy, right? So I go analyze. So I go and look at the board, and the board says 50 meters high. 50 meters is about 15, 16 stories HDB flat. So in my head, I told myself, 15, 16 story, no big deal. Can do. Because last time when I was in the army, I used to do parachuting. Airborne, Don't see me this kind of size, cannot do. Can do. Just that I have to be the last jumper. Because I'm very slow one. I come down, everybody go down, I'm still floating in the air. So jumping down from a plane is 1,000 feet, which is about 70, 80 story high. So in my head, 70, 80 story, no big deal. If 70, 80 story, I can jump down. What is 50 meters, right? So in my head, no big deal, can jump. Then I go and observe the bungee jump. The whole process takes about 20 seconds, over liao. So in my head, I imagine 20 seconds up and down, 50 meters only, no big deal. So I went to my daughter, I said, no problem. Papa, go with you. So we went, it's a tandem jump. Tandem jump means you stand side by side, they tie your legs. So they tie our legs up, we hop into the cage. Then in the cage we're laughing, taking plenty of pictures. The cage brings us all the way up to the top of the platform. They opened the cage, we got up. We were still laughing, very happy. And then finally I asked the dispatcher, I said, so how to jump now? He said, it's very simple, sir. All you need to do is just to hop to the platform and jump lah. I say, yeah, but surely there must be a way, left leg go out, right leg go out, or how. So, one thing I need to tell you, in bungee jumping, you cannot jump with your leg first. You got to jump with your head go down first. Because the rope is tied to the leg, If you jump with your leg first, very painful. So I said, okay, but how to go down with your head first? Is it like swimming, you plunge down? He said, no, very simple. All you need to do is you hold your daughter on the waist, your daughter will hold your waist, then you count 1, 2, 3, then you bend forward. At a certain angle, gravity takes over. Correct, like you go, then it goes down, right? Simple. So we hop to the platform, then I look down. Everything in my head went missing. It's really very high. Because at 50 meters, I can see my wife and all my friends there clapping for me. Come on, come on. At that time, I wanted to punch my wife. Because she was, go on. Well, I tell you, my legs soft, And there's one thing you need to know about parachuting, 1,000 feet from, airborne, when we do the airborne jump, is that 1,000 feet, you cannot see anything. And it is actually less scary when you cannot see anything. It's actually more scary when you can see. Secondly, in parachuting, we don't jump with our head first. We jump with our leg first. Okay, in truth, actually we don't jump one. We get kicked out. Nobody jump one. We go until there, the airplane, the jump master, you are down already. Okay, and because the plane is flying so fast, you don't come down straight. Actually, your body goes sideways. You don't feel the gravity at all. 3 seconds later, the parachute opens. This is different. This one, I have to jump myself. And I've got to put down my head first. And then at 50 meters, I sure can feel gravity. Okay, anyway, cut the whole long story short. I'm not here to tell you about my bungee jumping experience. After we go tea break, we go tea break. Okay, cut the whole long story short. I'm supposed to just count 1, 2, 3, jump down, and my daughter and me were supposed to shout, Singapore! First try, I didn't dare to jump. I hesitated, I went out. I hold. Then my daughter looked at me and said, Pa, why don't jump? I said, scared lah. I think not scared lah. They said, Pa, hurry, I want to go down. Because they're 9 years old, they don't understand. Finally, on the second try, I fell down. I didn't go down at my head first. My leg just basically softened, I go down. I was supposed to shout, Singapore. Nothing came out. I was closing my eyes throughout that 20 seconds. I could hear my daughter laughing. But I couldn't say a thing. Nothing came out. 20 seconds later, finished. They lowered my tired body on a sampan boat that collected me. And then they brought us to the shore, untied my legs. I stood up. My wife came. She ran to me and said, how? I stood up. I looked at my wife and said, nothing. It's a piece of cake. But there and then, I promised myself, I will never ever do such a stupid thing again. You see, the head understand, but the heart cannot understand. Do you understand? This is I didn't tell you a story for nothing. Okay? It's a very important story. Okay, in investing, it is the same. I can give you all the theories now. The head understand. Stay invested. Keep investing. Don't worry. If you buy the right stuff, right through, this is the bad time to sell. You all understand. When you walk out of this seminar hall, your heart takes over. How do you then align the head and the heart? It is about understanding your risk appetite. And to understand your risk appetite, 3 things you must know. You must know your need to take risk, your ability to take risk, and your willingness to take risk. Okay? You have to align the 3. Okay, so let's talk very quickly about need to take risk, ability, and willingness. Okay? Now, okay, so how much risk do you need to take depends on what is your need for returns. Today, if your need for return is, let's say, 4% per year, actually your need to take risk is very, very low. Actually, you don't even have to take risk. Just put in a special account, you get 4%. If your need for return is 4%, your need to take risk is very low. If your need for return is 6%, your need to take risk is medium. If your need for return is 8%, then your need to take risk is much higher. We understand that, right? Yeah. If your need for return is only 1%, then actually you don't need to take risk. Alright, so that's the first thing you need to decide. That's why I say that for accumulator, younger people saving towards your retirement, you've got to ask yourself first, what is the return that you need? The second thing is ability. What determines your ability to take risk? Your age. The younger you are, the higher the ability to take risk. The more time you have, the higher ability to take risk. Financial health. if financially you are healthy, higher ability to take risks. What determines your financial health? If you have a stable job, good financial health. If your debt level is low, good financial health. If you got enough savings, emergency fund to last you for at least 6 months, if you lose your job, good financial health. These are some of the examples of good financial health. So if you take care of your financial health, your ability to take risks goes up. Physically, if you are healthy, ability to take risks is higher. Insurance, if you've done all your insurance planning properly, higher ability to take risks. If you are single, higher ability to take risks. If you are married, lower, because you've got to take care of the spouse. If you are married with 2 children, even lower ability to take risks because you've got kids to take care of. If you've got 10 children, then forget it, you've got no ability to take risks. Okay? Now, if you need liquidity, that means if you invest your money, you need your money to quickly come back. Your ability to take risks is lower. If you can invest long term, no liquidity needs, then your ability to take risks is higher. If you are investing $1 or $1,000, ability to take risks is high. If you are investing 1 million, wow, you a bit scared already because that's all your money. Your ability to take risks goes down. Are we all okay? And finally, is your willingness to take risks. Okay, which usually in the industry we do it using a risk profile questionnaire. But you don't even, without even doing a risk questionnaire, you will know whether you feel like taking risks or not. So to determine your risk appetite, you got to combine these 3 factors together, right? This is revision. I've done this many times. So quick one. Today, if you don't need to take risks, cannot take risks, but want to take risks. Don't need, cannot, but want. Should you or should you not? Should not, You need, you don't need, you cannot, but you want. Today, your children don't need to take drugs, cannot take drugs, but comes back home and say, I got feeling to take drugs. What do you tell them? Shut up, don't take drugs, right? Don't need, cannot, even if you want, you shouldn't. Today, you need to take risks. You can take risks, but you don't want. Should you? You need and you can, but you don't want. Should you? Your kids come back home and say, tomorrow got exam, need to study, can study, but don't feel like studying. Should he or should she not study? Study. If don't want, must be prepared to face consequences. Fail. Yes? So if you need, if you can, and if you are unwilling, actually you should, unless you are prepared to get a lower return. So these 3 factors, you play around with it, will determine your risk appetite. And if you are investing based on your risk appetite, there is a much higher chances that when the market goes up, goes down, goes up, goes up, goes down, you have a better chance of staying invested and not jumping out at the wrong time. Okay so far? Okay so far? So what has Singapore Savings Bond got to do with my story? So where do you use Singapore Savings Bond as an accumulator? Okay, well, one place you can use your Singapore Savings Bond is it is an alternative to your savings in a bank account. Monies that you set aside, you meant it for emergency purpose. You know that you are not going to touch it. Okay, and anyway, it is in the bank. Then an alternative choice is to take it out and buy the Singapore Savings Bonds. Yeah, because the coupons or the interest is likely to be higher than your fixed deposit. Am I okay so far? Yeah. So for accumulator, that's where you use your Singapore Savings Bond. Now I'm going to move to the next slide. Okay. Now let's say today you decided based on this, you decide that you are medium risk taker. Let's say your need to take risk is 6%. Your ability to take risk is medium. Your willingness to take risk is also medium. You don't mind. You know, Singaporeans, we are medium people. You all know, right? Because I oftentimes ask Singaporeans, left or right, they always say center. Low or high? Medium. Okay? Because medium, okay lah. That's us lah. So if you are the medium investor, need to take risk, ability to take risk, willingness to take risk, all medium, then you should choose the medium portfolio lah, which is the balanced portfolio over here, right? So the balanced portfolio, an example of a balanced portfolio, and please let me say this is a sample portfolio. Please don't take picture, then go out, buy exactly the same thing. Sample. Okay, so how it looks like is, if you are investing in a medium portfolio to grow towards your money, okay, an allocation, example of an allocation that will give you medium returns with medium risk appetite or medium risk up and down, is about 40% of your monies you should be investing in bonds. With the remaining, you invest in equities or commodities, 60%. Okay, this kind of allocation sort of is considered medium. Okay, because you have a good balance of stocks and bonds, medium. Okay, so where can you use Singapore savings bonds? If you take a look, you can use your Singapore savings bonds here. Of course, under your bond allocation, okay, under your bond allocation here, the Singapore bond, SG is not Singapore government, SG is Singapore bonds. You can buy the retail bonds. You can go and buy the stat board bonds. You can go and buy the LTA bonds. You can buy the Singapore government securities, or you can buy the Singapore savings bond. But can you listen to me very carefully? Okay, although I put down here that you can consider using the Singapore savings bond, there are certain characteristics of the Singapore savings bond that may not be that suitable. One, I have said already that when equity price drop, what you want from your bonds is for it to go up, right? To balance it off. The Singapore savings bond can't help you to do that because the price doesn't change. You got me? And what is the maximum you can buy for the Singapore savings bond? How much can you hold? 100K, that's the most. Yeah. Some of you here, when I look at your face, your portfolio is 2 million kind. 2 million? Then you want to put like what? 25% into Singapore savings bond, for example. Okay? You cannot buy. You cannot how to buy? How to buy like what? 500,000 of Singapore savings bond. You can only buy 100,000. That's the other problem, right? The other problem is also you cannot do rebalancing. Meaning to say after a while, the proportion change already, right? Then you want to sell some bonds, buy some bonds. It's not so simple. And even if you want to buy 100,000, Bopao, you can get 100,000, right? Because, as explained earlier, it depends on allocation. You may not get. So that is a bit tricky if you want to use a Singapore savings bond as part of your portfolio. But if your portfolio size is small, maybe. But if your portfolio size is a bit bigger, then it's harder. Okay, so far? Yes? Okay, great. Now, so I'm done with the accumulation side. Okay, so two things you take away from this session here is that for those of us who are younger and saving towards the three things, especially the money part, you can use the Singapore savings bond as an alternative to your bank account to beef up your ability to take risks. The second thing you can do is you can use the Singapore savings bond as part of your bond portfolio, but please keep in mind some of the restrictions of the Singapore savings bond. Okay? Now, how about for people who are in retirement already, withdrawal? Okay? Now, under the withdrawal phase, remember for retirees, okay, the income, I always further categorize it into two categories. Okay, one part is the must-have income, the other part is the additional income. Let's say, okay, when you retire, let's say you want $3,000 per month income, but you say $2,000 I die must have. The $1,000, some months I get more, some months I get lesser, doesn't matter. But out of the $3,000 per month that I want, $2,000 die I must have. It is the must have income. Got it? Got it or no got it? Got it, huh? Okay, so again, where can we use the Singapore savings bond in this? Well, under the must have income, you can use CPF Life, you can use private annuities, you can use retail bonds, and you might even consider using the Singapore savings bond as to give you the must have. You can consider that. Okay, the additional income, you have to invest your money. So these instruments will give you the must have income. Die must have, because all these are very safe. Then you invest the rest. If the investments does well, you got additional. If that particular year the investment is not doing very well, then maybe you are not going to get a lot of additional income. But it doesn't matter. Your must have income, you have. So, last example, and then I'm done, okay? So, that's the plan. For those of us who are retirement, as an example, you have now accumulated, let's say, about $500,000. Okay? So, how do you then invest this $500,000? Okay, what you can do is that you can put 30% of it in CPF Life. That's going to give you like about $1,200 from age 65 years old. You can buy an immediate annuities that will pay out immediately. You can put $150,000. You can buy a deferred annuity using $150,000, and then the rest of the $50,000 you can go and invest it. So this is an example of a plan. And let's say this guy here, he is 55 years old. And his plan is this. His plan is that at age 55 years old, he wants to start slowing down. Okay? But he really only wants to retire at age 65. So at 55, he slows down, earn lower income. At 60, he slows down some more, earn slightly lower income. At age 65, he fully retires. That's his plan. Okay, so with this allocation, okay, what else he can do? He can actually put some, he must make sure that he has some emergency cash, and you can use his Singapore Savings Bank or Singapore Savings Bond for that emergency fund. Because even as a retiree, you must have some emergency fund, not invested. Okay? And also, he can use his Singapore Savings Bond as part of this investment portfolio. Okay? And this is how it will look like when it pays out. Okay? At 55 years old, because of the immediate annuities that he has bought, it will pay out about $500. Okay, got it so far? 5 years later, his deferred annuity, another $500 will be paid. So he gets in total about $1,000. At age 65, his CPF Life of about $1,000, $2,003 will be paid out. So cumulatively now he has got about $2,004. Okay, and then at age 65, he can fully retire already. Am I okay? Are we okay? Look at me. Look at me. Okay, because not a lot of time, so I need to just slow down a little bit just to cover this important point before I end it. Remember, I said that for a retiree, you must have, your income is categorized into two parts. The must-have part and the additional income part. In this plan, if you look at it, the die must-have part, must-have income part is this. 1, 2, 3. This will give him the die must-have. This is the additional because it's investment. For Singapore Savings Bond, it is really just you set aside some cash for emergencies, not invested. Okay, it's emergency. Or you can also use Singapore Savings Bond as part of this investment portfolio. But again, be mindful of the restriction of using Singapore Savings Bond as part of your bond portfolio. And with this, you get $500 from age 55. He can slow down a little bit. $1,000 at age 60. At age 65, when the CPF Life comes in, he get about $2,004, and then he can actually retire completely. This is the die must have. We haven't even touched the investment portion. If the investment portion does well, he got a bit more than $2,004. But if his investment at that year maybe is not doing too well, then he don't sell lah. Then he still die will have about $2,400. I'm going to skip this. So far, are we okay? Okay. In short, let me just summarize this. Okay, and then I'll hand it over to the next speaker already. If you are an accumulator, you can use the Singapore Savings Bond as part of your emergency fund. You can use the Singapore Savings Bond as part of your bond allocation for your portfolio that grows towards that retirement fund. However, please note the restrictions, some restrictions of the Singapore Savings Bond. If you are a retiree, you can use the Singapore Savings Bond as the must-have income. For the must-have income part, you can use the Singapore Savings Bond to park your emergency fund as well. you can also use the Singapore savings bond as part of investment portfolio. Again, note the restriction of using SSB as part of your investment portfolio. Okay? The way I look at the SSB, actually it is more a good alternative to the saving account, more than part of your investment portfolio because of that restriction. Okay? I know usually people ask me, so should I buy or should I not buy? Just tell me, right? I think it's quite a no-brainer just to park some of your money in the Singapore savings bond, right? Unless you know that when you buy, 1 year's time I must take out the money one. Sometimes the fixed deposit could be better. Yeah? If you know when you park the money in, I die next year, I need my money, I'll take out. Then perhaps don't do that. Don't park in the Singapore savings bond. Put it in your FD. Yeah? But, okay, if you are prepared to put a bit longer, actually it's really a no-brainer just to shift some of your money to the Singapore savings bonds because it's safe and the interest is pretty decent. Okay? Thank you very much. Okay, I hope you have a good evening. Thank you.